Welcome to The Explainer. I am so excited you're here because today we are diving deep into the mechanics behind what is gearing up to be the largest initial public offering in human history. We're talking about mind-boggling numbers and quiet structural shifts that are absolutely going to reshape the market. Okay, let's dive right into this. It feels like a total paradox, right? I mean, who on earth is lining up to buy a company that is actively losing $5 billion a year, yet is somehow demanding a record-shattering $1.75 trillion valuation? It sounds completely absurd. It sounds like financial fiction, but it's happening right now. Well, the cold, hard truth? The answer is you. Within just a few weeks, your passive index fund, your 401k, your retirement account, they are going to be some of the biggest buyers of this stock, whether you actively asked for it or not. So this isn't just some high-level Wall Street finance story. This is deeply personal for literally anyone with a retirement portfolio. To really wrap our heads around why this matters, we have to grasp the sheer scale of what Elon Musk is preparing with this upcoming SpaceX IPO, $1.75 trillion. That is the target valuation. It's a number so incredibly massive, it almost breaks the human brain trying to contextualize it. Just to put that into perspective, at a $1.75 trillion valuation, SpaceX would be worth more than every single American defense contractor combined. It would be worth more than the market caps of Coca-Cola, McDonald's, Disney, Nike, and Starbucks all put together. So the only way a valuation this astronomical makes any logical sense is if SpaceX is the flawless, futuristic money printer the public generally believes it to be. But, if you ask a random person on the street what SpaceX actually sells, most of them will say rockets or maybe trips to Mars, but they'd actually be wrong. SpaceX isn't just one giant company. It's really three distinct businesses stacked on top of each other. And to understand what you're actually buying into, we've got to peel back the onion a bit, because there is the good, the bad, and the very ugly. Let's start with Business 1, XAI, the bad and the ugly. So, this is the AI lab Elon Musk founded back in 2023, which SpaceX then acquired in an all-stock deal that valued XAI alone at $250 billion. You'd think a $250 billion AI startup is financially rock solid, right? Or at least still has its founding team intact? Well, neither is true. By March of this year, every single one of XAI's 11 co-founders, we're talking brilliant researchers from DeepMind and Google, had walked out the door. Elon publicly admitted the company basically had to be rebuilt from the foundations up. For context, OpenAI generates around $24 billion in revenue, Anthropic generates over $30 billion. XAI? They estimate just $1 billion in revenue, yet command a $250 billion price tag. The market is pricing XAI like it's Emirates, but right now it's operating a lot more like Spirit Airlines. It's actively burning over $1 billion a month. Moving on to Business 2, rockets, the namesake. This is the part of the company you probably picture, launching government satellites, sending cargo to the International Space Station, and running crewed missions for NASA. But here is the reality check. Last year, that incredible, highly publicized rocket business only generated about $4 billion in revenue. Now, that might sound like a lot, but when you compare it to a nearly $2 trillion total valuation, it's just a drop in the bucket. It's roughly a quarter of the company's total revenue, yet this rocket business is being valued as if they've already successfully colonized Mars. And that brings us to Business 3, Starlink, the absolute crown jewel. This is the true financial engine that's actually paying the bills for everything else. Starlink is essentially what happens if you build Comcast, but, in space. And it is the fastest scaling telecom company in human history. They've got over 10,000 satellites beaming internet down to more than 10 million active subscribers across 150 countries. And it's not just your standard consumer internet either. They are dominating maritime with ships and yachts, they're expanding into commercial aviation, and they even have a highly classified defense version called Starshield that works directly with the Pentagon. So how does all of this actually shake out financially? Looking at 2025 estimates, Starlink alone brought in $11.4 billion. That's a massive 61% of SpaceX's total revenue. But what's truly mind-blowing is the efficiency underneath that revenue. In just 2 short years, Starlink's profit margins exploded from 41% to 63%. They added over 20 points in margin expansion. So the margins aren't just good, they are rapidly accelerating. Okay, but here comes the gut punch. Let's look at how this builds together into one final financial picture. Starlink and the rocket business together brought in roughly $8 billion in pure profit. Incredible, right? But then XAI crashes the party. Because of that massive cash burn we talked about earlier, the total consolidated company, SpaceX plus XAI, actually ended up losing nearly $5 billion last year. Which leads us to changing the rules, the May 1st NASDAQ shifts. So we have a combined company actively losing $5 billion, aiming for history's largest IPO. How exactly does that work? Well, it's all about how the financial system is quietly changing the rules behind the scenes. First up, we have the fast entry rule. Under the old rules, a newly listed company had to wait 3 whole months before being added to the NASDAQ 100 index. This gave the market vital time for what's called price discovery, basically time to figure out what the stock was actually worth. But the new rule? It compresses that entire 3-month waiting period down into just 15 trading days. We are squishing 3 months of market testing into 3 weeks, which radically speeds up the automatic demand for SpaceX stock. Next up, there used to be a minimum free float requirement to even join the NASDAQ 100. A company needed at least 10% of its shares publicly available to trade. SpaceX is targeting a tiny float of just 4 to 5%. Under the old rules, they're completely disqualified. Under the new rules, that minimum is just gone. But it actually gets crazier because there's now a hidden multiplier. The new rules state that for companies with a float under 20%, NASDAQ treats that float as 3 times bigger than it actually is. So SpaceX's tiny 5% float gets weighted as if it were 15%. ETFs are literally legally required to treat it as a much larger chunk of the market. And this brings us to the ultimate result: manufactured demand. See, the NASDAQ 100 is tracked by over 200 investment products, controlling more than $600 billion in assets. Once a company is included in that index, every single fund that follows it is automatically forced to buy the stock. The NASDAQ didn't just bend the rules, they essentially rewrote them to engineer massive, unavoidable demand for companies listing with tiny floats. Now, who is actually going to be holding all this stock? Normally, an IPO allocates about 5 to 10% of its shares to regular retail investors. But SpaceX, they're targeting a massive 30% retail allocation. Why the huge jump? Well, the CFO of SpaceX reportedly told bankers that retail buyers have been incredibly supportive of them and are loyal to Elon. Translated from corporate speak, they're planning to dump 30% of this record-breaking IPO supply directly onto everyday retail buyers. Not for price stability, mind you, but banking on brand loyalty. I really want you to just take a second and absorb this quote from portfolio manager George Noble. Your 401k is the exit liquidity. Because think about it, the buyers and sellers here don't show up at the exact same time. The rules practically force the buyers in early. Shares are going to move from insiders, who are sitting on a very, very low-cost basis, directly into passive index funds and retail retirement accounts right at peak valuation. The mechanics of passive investing will simply buy it for you without you ever having a say. Which leaves us with this final, kind of provocative thought. Passive investing was sold to all of us as the smart, safe, set-it-and-forget-it way to grow our money. Low fees, automatic diversification, but the exact same feature that makes it so convenient also makes you a guaranteed automatic buyer for anyone who manages to squeeze their way into the index. So if passive investing is supposed to be the safest way to grow your money, what really happens to your retirement when the index forces you to buy what you never even asked for? Thank you so much for joining me for this explainer, and definitely keep questioning what's hiding inside your portfolio.